On September 25, 2008, a bank with $307 billion in assets simply ceased to exist, and nobody saw it coming until it was far too late. Washington Mutual didn't fail because of a single bad decision made on a single day. It failed because of a cascade of choices, each rational at the moment, each made by intelligent people operating on incomplete information. By the time the full picture came into focus, the institution was already hollow. The largest bank failure in American history didn't announce itself with a bang, it whispered. March 1983. Washington Mutual was a regional savings and loan, solid, boring, safe, the kind of institution that financed mortgages and paid modest dividends to retirees who'd banked there for decades. It had $8 billion in assets. It was profitable. Nobody was interested in what it did because it did nothing remarkable. That was its strength. Then came deregulation. Between 1980 and 1985, Congress systematically removed the guardrails that had contained savings and loans since the Depression. The restrictions on what assets they could hold, gone. The caps on how much interest they could pay depositors, gone. The requirement to focus on mortgages, dissolved. What had been a cautious, regulated utility suddenly became a casino with a banking license. Most savings and loans imploded in the late 80s. The S&L crisis cost taxpayers $124 billion. Washington Mutual survived, but survival came at a cost. In 1989, it was merged with a failing competitor. The merger added 200 branches overnight. It also added something else. The culture of a bank that had learned it could take enormous risks, and if things went sideways, someone else would pay. June 2000, a new CEO arrived. His name was Kerry Killinger, and he had a vision. He wanted Washington Mutual to stop being a regional player. He wanted it to be national. He wanted it to be aggressive. He wanted it to grow faster than any bank had grown before. Under Killinger's strategy, WAMU would pursue what the industry called option arms, adjustable-rate mortgages that started cheap and reset upward. They were profitable. They were also ticking time bombs, and almost nobody in the industry understood the mathematics yet. Here's what Killinger knew: housing prices had never fallen nationwide in the post-war era. Here's what he didn't know that was about to change. Between 2002 and 2007, Washington Mutual issued $143 billion in mortgages. Many of them went to borrowers with poor credit. The bank didn't care. Housing prices were rising. If a borrower defaulted, the collateral was worth more than the loan. The math worked, or so it seemed. The gap between what the leadership believed and what was actually true would cost 16,000 people their jobs. The early 2000s were a masterclass in moral hazard. WAMU's loan officers were compensated on volume, not quality. If you wanted a mortgage with a 3% down payment and a stated income that nobody would verify, you could get one within months. The bank's own risk management department flagged the problem repeatedly. The reports went up the chain. Killinger read them, and then he raised the targets. The institution had built a machine that rewarded people for taking risks they didn't fully understand with money they didn't own. By 2006, Washington Mutual was the largest mortgage originator in America. Not the largest bank, the largest mortgage originator. 60% of its loan portfolio was composed of loans it planned to sell off to someone else. WAMU wasn't actually holding the risk, it was packaging it and passing it downstream to mortgage-backed securities, to investment banks, to pension funds, to anyone who'd buy it. The bank was making money on volume. The rest of the financial system was absorbing the danger. August 2007. The first tremors, subprime mortgage delinquencies started climbing. The secondary market for mortgage-backed securities froze. Suddenly, the loans WAMU had been selling to Wall Street couldn't be sold anymore. They were stuck on the books. The bank had to hold them. The bank had to account for their risk. Within weeks, WAMU's share price fell 20%. The leadership didn't yet understand they'd run out of runway. September 2007. Killinger was replaced. A new CEO, Alan Fishman, was brought in to stabilize the ship. Fishman was an outsider. He'd run other banks. He believed he could navigate this. What he didn't know, what almost nobody knew, was that the housing market was about to enter freefall, and that WAMU's entire asset base was built on the assumption that it wouldn't. 2008, housing prices collapsed. The option ARMs reset. Borrowers who'd been paying $1,500 a month suddenly owed $2,800. Defaults skyrocketed. WAMU's loan portfolio, which had seemed so safe, revealed itself as fundamentally toxic. By March, the bank had lost $3 billion. By June, another $3 billion. The stock was trading at $2 a share. The FDIC was watching. And the markets were beginning to understand that WAMU wasn't the only bank sitting on a mountain of bad mortgages. September 15, 2008. Lehman Brothers collapsed. The financial system seized. Credit markets froze. Suddenly, every bank was suspect. Depositors at Washington Mutual started withdrawing cash. $1 billion left in a single week. The bank was facing a classic run, not because it was insolvent, but because everyone believed it was. And in banking, belief and reality are indistinguishable. The prophecy had become self-fulfilling. September 25, 2008. 10:30 a.m. The FDIC made its decision. Washington Mutual was closed. Its assets were sold to J.P. Morgan Chase for $19 billion. The bank that had $307 billion in assets ceased to exist in a single morning. 16,000 employees found out they no longer had jobs. Depositors were protected. The FDIC guarantee covered them, but the equity was wiped out. Shareholders lost everything. Creditors lost 70 cents on the dollar. The cost to the government was $18 billion. Not in cash, the FDIC insurance fund covered it. But in terms of what the taxpayer was ultimately liable for, the number was staggering. And that was just Washington Mutual. Across the financial system, the same pattern repeated. Banks had made decisions that were rational given what they believed at the time. But what they believed was built on the assumption that housing prices would never fall nationwide. That assumption was catastrophically wrong. The investigation that followed revealed something uncomfortable. There was no smoking gun, no single moment of fraud, no executive who knowingly lied. There was just a culture that had systematically underestimated risk, that had aligned incentives toward short-term gains, and that had assumed the future would always look like the past. The system had worked perfectly until it hadn't. Washington Mutual's collapse wasn't a mystery. It was a decision tree. Deregulation opened the door, growth targets created pressure, compensation structures aligned incentives toward risk, market conditions changed. And when they did, the institution that had seemed so solid simply evaporated. The largest bank failure in American history happened not because anyone was stupid, but because intelligent people made rational decisions based on incomplete information. And the cost was counted in billions. Subscribe to explore the decisions behind every major collapse, where the story always starts long before the crisis hits.